People in business for themselves frequently travel, whether away from home or locally. But what do we mean when we say away from home to describe business travel? The difference between travel away from home and local transportation is significant in determining what expenses can be deducted from business income and which can't. I'm the Tax Geek, and here are business travel basics, oversimplified. If you haven't watched my earlier video on the concept of tax home, you might want to check that video out before watching this one. Click on the card above or in the video description below. Being able to define travel as away from home versus local transportation is important. The expenses you can deduct from business income for local transportation are limited to the vehicle expenses themselves, or standard mileage, plus any additional expenses for tolls, parking, local transit fares, taxis, or rideshare expenses. Whereas, when traveling away from home, you can deduct all these expenses, plus travel expenses to and from the destination, lodging, a portion of your meals, and incidental expenses such as dry cleaning or laundry. So when is travel considered to be away from home? You are considered to be traveling away from home if your business duties require you to be away from the general area of your tax home substantially longer than an ordinary day's work, and you need to sleep or rest to meet the demands of your work while away from home. Distance traveled in and of itself is not necessarily taken into account. Overall, if it is not practical for you to return to your tax home at the end of each workday, the travel is considered away from home. Business travel must be temporary in nature, with a definite plan to return to your tax home within 1 year. If there is no such definite plan to return, or the travel is expected to last more than 1 year, your tax home shifts to the new location and the travel expenses are no longer deductible. But what if your travel plans differ from what actually happens? If the business travel is expected to last less than 1 year and your trip is extended to more than 1 year, travel expenses are only deductible from business income up to the point where it becomes clear the travel will last more than 1 year. For example, our traveling nurse Wendell, who usually works on contracts in the Boston area, accepts a 2-month-long contract at a New Hampshire hospital. After a month on the job in New Hampshire, the hospital is impressed with Wendell's work and offers to extend his contract to 18 months, which Wendell accepts. When Wendell accepts the contract extension, his tax home shifts from Boston to Lebanon, New Hampshire. He can still deduct his travel to Lebanon and his lodging and meals while in Lebanon up to the date he accepts the extended contract. If the business travel is expected to last more than 1 year and ends up before the 1 year is up, the travel expenses don't become retroactively deductible. That's because at the outset of the travel was expected to last more than 1 year. It's the intention at the start of travel that counts in this case. So what happens if, while away from home for business, you temporarily return to your tax home? You can deduct the travel costs of returning to your tax home, plus any continuing travel expenses at your travel destination. Let's look at Wendell again. On a 6-month contract away from Boston, he returns to Boston for 3 days to attend a friend's wedding. He can deduct his travel expense to and from his tax home, but not any expenses while he is at his tax home. Plus, he can continue to deduct the cost of his temporary accommodations in New Hampshire while in Boston. This should go without saying, but the primary purpose of business travel must be business-related. If there are incidental personal activities, that's okay, as long as any expenses directly related to the personal activity are not deducted. As an example, if you go to New York for a 3-day business-related conference and attend a Broadway show while you are there, the entire trip remains deductible. You just can't deduct the cost of the theater tickets. The same works in reverse. If the primary purpose of the trip is personal and some business is transacted, only those expenses directly related to the business purpose are deductible. For example, if you take your family on a 1-week vacation, but during the week you meet for dinner with a potential client in the area, only the expenses of traveling to and from the meeting, and part of the cost of the meal itself, are deductible. Speaking of family, can you deduct the expenses of another person or family member who accompanies you on business travel? You can only if the person is A, your employee, and B, has a bona fide business purpose for the travel. This usually excludes spouses and other family members that do not actively participate in the business. If you do take your spouse or family on business travel, you must be careful to separate their non-deductible expenses from your business-related expenses. For example, if you're sharing a double hotel room with your spouse, only the cost of a comparable single room can be deducted. And that's a look at the fundamentals of business travel. As with all my videos, additional resources and information are linked in the video description. Please like the video if you found it informative, subscribe and click the bell icon to be notified of any new videos on the channel. Your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.